So thank you all for joining today's webinar. I am honored to have Keith Martin and Darren Van't Hof joining us for the conversation today. We certainly have a lot to talk about. First, I'll start with a bit of housekeeping. We have disabled participant chat, but we would love to hear your questions. If you have any questions at all, please feel free to drop them in the chat, and we will aim to answer as many questions as we possibly can. If you have any issues with the connectivity, please go ahead and email sam@reunioninfra.com. I'll start by giving an introduction to today's speakers, and I'll kick it off with myself, Andy Moon, co-founder and CEO of Reunion. We work very closely with leading clean energy developers and manufacturers, along with leading taxpayers to purchase and sell clean energy tax credits. Since 2024, we have facilitated over $8 billion in tax credit transfers, and I personally work very, very closely with many of our Fortune 500 clients that are looking to purchase credits. I will hand it over to Keith for an introduction.
Hi guys, Keith Martin. I'm a tax lawyer in Washington. I'm with Norton Rose Fulbright. I run the project finance group at that firm and done so for 25 years.
Thanks,
Hey,
Keith.
Andy, thanks for having me. My name is Darren Van't Hof. I am the current and interim CEO of the Solar Energy Industries Association. Prior to that, I led a group at US Bank where we invested annually anywhere between $2 and $5 billion a year in renewable energy projects around the country.
Thank you, Darren.
Yep.
I couldn't think of two better people to dive into the four major topics that we are going to discuss today. These are questions that we receive on a daily basis from clean energy developers as well as taxpayers. We'll start by talking about FEOC guidance, which is probably the hottest topic today. The foreign entity of concern rules that came out with the OBBA version of the legislation have been a large source of concern and questions amongst clean energy developers. And so that's the first topic that we'll focus on. We will then move into the tax equity market. It's been widely reported that there's been a slowdown in tax equity investments towards 48E credits. And so that will be the next topic. And then we'll zoom out and talk about sort of legislative outlooks post OBBA, as well as market dynamics for the transfer and energy markets. Before we go to the conversation, I'll start by sharing just a few recent pieces of research that Reunion has published that I think would be of interest to this audience. First of all, the Financial Accounting Standards Board released a new rule that public companies need to disclose additional information behind their effective tax rate calculations. And what that means in practice is we are seeing a lot more disclosure of companies that are purchasing clean energy tax credits. This only needs to be disclosed if the purchase exceeds a materiality threshold. So not all companies are disclosing their purchases, but we have seen an increase from 4.9% of companies in 2024 up to 8.5% in 2025 disclosing purchases. When we add in Reunion's internal information about companies that have purchased but are not disclosing credits, we think that that number is in the teens, anywhere from 13 to 15%. One notable pattern we've seen is a very large increase in growth amongst smaller taxpayers, in other words, companies that are paying less than $200 million in annual tax. Next, and Keith and Darren, please feel free to chime in here as appropriate. We did also publish an article about a real-world case of tax credit recapture. Recapture is something that is always discussed in very, very great detail on tax credit transfers involving ITCs, but in practice, we rarely see it. We've rarely ever seen it happen. And therefore, when we did see a public disclosure around a real case of recapture, that very much piqued our interest. Enterprise Financial has purchased tax credits generated by Sunnova, a resi solar developer that went into bankruptcy. And because the credits were directly held on the balance sheet of the Sunnova entity, a recapture was triggered due to a change in ownership. Now, the good news on this transaction is that the buyer did procure sufficient tax credit insurance, and they expect to be made fully whole from the recapture event. We will mention that there are others that also purchase credits from that were originated by Sunnova, but those were not subject to recapture because they were housed within tax equity or other partnerships that were not part of the bankruptcy estate. Last, we recently did a transaction that was between a ethanol producer and a club of two publicly traded banks. We thought this was notable because the follow-on bank did not have any previous experience in transfers, but they were able to really lean on the experience, the negotiation, and the diligence of the lead bank, which set the terms for the transaction. And this was a great experience for the seller because they were able to sell their full supply of credits in one single process, even though there were two distinct buyers. So without further ado, we will move on to the Q&A. So we'll start by talking about FEOC, and FEOC stands for the Foreign Entity of Concern rules, which has been probably the largest single topic we've been getting questions on from clean energy developers. Keith, I actually listened to your Norton Rose podcast, which was fully dedicated to FEOC. So I thought maybe you could set the stage by giving just a brief recap of the three prongs of FEOC: material assistance, effective control, and ownership.
FEOC is an effort by the Republican Congress to rid the U.S. renewable sector of Chinese equipment, Chinese equity, debt, participation in management, and use of intellectual property. So I think of it as three tests. One is a material assistance limit on the amount of Chinese equipment that can be used in a project. That's a math exercise. Number two is looking at the entity that proposed to claim tax credits and asking whether it has too much Chinese equity, debt, or participation in management. And number three is scrubbing all the supply contracts with majority Chinese-owned companies and making sure they do not have any of 13 contract provisions that Congress said are a problem. The two most common problems we're finding are, number one, boilerplate intellectual property language that says if I buy your piece of equipment, I get a royalty-free license to use your intellectual property. That is a problem. And number two is warranties, where the equipment vendor has basically exclusive rights to repair the facility or the equipment. And that usually comes up by the warranty is voided if the customer makes repairs itself.
Thanks, Keith. And we did receive some guidance earlier this year from Treasury back in February, which provided some clarity, mainly on safe harbors and material assistance, but we did not get further guidance on the prohibited foreign entities or effective control. Could you provide some additional color there on, Keith, what is still needed from Treasury, and probably most important, when do we expect additional guidance to come out?
At this point, we're not expecting additional guidance, proposed regulations until year end. It may even slip until early 2027. There is a possibility of a so-called skinny guidance. The banks have been crying that they need guidance sooner than that. So the Treasury has considered issuing something smaller, but it doesn't appear Treasury has made much progress on that. There isn't a consensus yet on what should be included in it or what it should say. To give you a flavor of what people are waiting for, in a tax equity partnership is the determination whether it is a prohibited foreign entity and therefore can't claim tax credits made at the partnership level, or do you make it at the partner level? Another thing people are waiting for is on effective control. For example, what I mentioned about warranties, is that a problem? The statute says that the equipment vendor can't be able to repair the facility on an exclusive basis. Is it a problem if it is the repair party under a warranty? The customer can decide whether it wants to give up the warranty. Does that, in effect, make the vendor the exclusive repairer?
Super helpful. Darren, maybe you could weigh in from SEIA's vantage point. What are you hoping for in terms of where the outstanding FEOC guidance will land?
I think that was a really good summation. I mean, I think maybe even a bit more specifically around the statutory test, I think effective control, just going back to that one, is really the one. If you think about, the kind of the blood flow of the industry is capital, and that is the one thing that's really holding up a lot of capital. Rules around equipment and interconnection. Does it have to comply with the same types of domestic content as the other equipment? Those are the things that maybe I haven't that I covered that maybe Keith didn't specifically say, but those would be the things that we're looking at. And SEIA does spend a lot of time with Treasury. They work closely with them really the first half of the year, the last part of last year, really getting what they did ultimately publish, but it clearly wasn't enough. And the fact that it's, really being punted to the end of the year is unfortunate.
For sure. It's definitely been challenging, and we've definitely seen the vast majority of our buyers requesting that we present credits that are exempt from FEOC consideration. So namely legacy Section 45 and 48 credits,
Yeah.
or credits such as 45Z, which have a much lighter lift in terms of FEOC for 2026.
Yeah.
One particular sticking point is the insurance markets. In general, we hear that insurance markets are not providing coverage for FEOC risk, although we have seen a couple of policies that are very specifically providing coverage on material assistance. Keith, are you seeing any further insurance coverage outside of material assistance, or have you seen many policies around material assistance?
We have seen some coverage, but it's sparse. And the brokers are telling us that there is a limited amount of capacity for FEOC coverage, but not much. I think this is just typical. Whenever there's a new provision, it takes a little while for those who are bearing the risk to feel like they've got their arms around it.
Yeah. I mean, from the bank's perspective, the ones that don't require insurance, we're seeing just a lot of very specific and hard underwriting that, sponsor strength of relationship. Those are the things that are probably getting people there that are providing capital. Because the technical answers aren't great. So you have to get there with, best assumptions and really strong sponsors, good projects.
Yeah, for sure. And I think maybe one of the obvious answers is doing deals where the sponsor is providing a guarantee from an investment grade entity. Darren, are you seeing folks get comfortable with deals where the sponsor is not investment grade and they also don't have insurance covering FEOC?
Yeah, they do struggle with those deals. I think it's important. I think a lot of the entities by which you get the indemnification, often they're not investment grade just by nature of IPPs and the nature of the business. So it's really how far upstream can you go, and is there a parent company willing to actually take that risk in front of their projects?
Yeah.
We've seen a couple banks willing to step in and act as the guarantor in exchange for the upside on the tax credit sale proceeds above some threshold like 90 cents.
That's very interesting.
Yeah.
And Darren, are there in the absence of an investment grade rating, are there other metrics that would get banks comfortable, such as we see a multiple of tangible net worth, as a fraction above credit size?
Yeah. A lot of times we would see balance sheets that they weren't investment grade because they never had a rating put on them, but they were certainly strong enough to qualify should they have been rated or had they been rated for other reasons. So yeah, I mean, you can look at, EBITDA, you can look at liquidity, you can structure covenants into someone's balance sheet. There's a lot of ways you can get there. Investment grade's kind of the lazy way or the shortcut to getting there, but you can do original underwriting.
Yep, absolutely. And Keith, are you seeing developers change the way that they're structuring deals or contracts, as you mentioned before, as a way to mitigate future effective control risk? I guess what steps are developers taking to future-proof FEOC?
We are writing lots of FEOC memos. I think the big law firms have been wrestling with this statute since we're living with it since May last year, and they're feeling fairly comfortable about most of it. So we're scrubbing supply contracts. We just fed 300 contracts, many of them Chinese, into AI with instructions to look for the stuff that could be effective control. So that's what they're doing. They're scrubbing contracts.
Makes sense. And And maybe a question for you, Darren. I guess for a seller just trying to close a deal that has FEOC exposure, do you have any advice for developers as they look to tackle this?
Uh, Not, I mean, it's a lot of what we're talking about. It's, finding an insurer who's gotten comfortable, really spending some time with good counsel, getting really good advice around, what's in the contracts. It's really, it's a lot of work. And I think, projects that are smaller, developers that aren't as well capitalized, it's a lot to expect for particularly smaller deals to really get them over the hurdle. We're still seeing a lot of, I mean, the industry is still seeing a lot of just Section 45 and
Mm.
48 deals in the market. So, I mean, there's still a lot of activity going on. I don't want people to think the market is like hit the brakes. I mean, there's still a lot moving. And I think, honestly, we're seeing more activity now or as much as we've ever seen across the industry. So this isn't, this is a major issue and you're correct in leading with it. But, I don't think Keith is bored. I know we're not.
No, and I think Darren, you hit on, I think the news reports that the market is frozen are just not correct.
That's
Not
correct.
our
That's
experience.
yeah.
Yeah, absolutely. I think there was a much bigger impact in 2025 when, at the first half of the year, there's uncertainty around what OB3 would contain and whether there would be retroactive repeals of credits. That kind of made some buyers skittish. And once OB3 came out in July of 2025, all the buyers had to recalculate their tax liabilities. And in many cases, their tax liability was much lower. And that had an impact in 2025. But we are seeing uh, a very, very fast market in 2026. I'd say that buyers are far ahead of where they were last year in 2025 in terms of interest and willingness to dig into markets. And so I'd say, while we typically see seasonality where Q1 and Q2 are less busy, 2026 has been very encouraging in the sense that buyers have been very ready to transact and interested in sort of digging in on 2026 credits early. In fact, we also have a number of large buyers that are looking forward to 2027 and looking to commit today to try to get a better price. Are you seeing a lot of that forward activity as well, Keith?
We are. We're not seeing long-term forward purchases like 10 years of PTCs, except in a few cases. There may be 2 or 3 or 4 years. The buyers expect a step down in the credit price over that time period. And most of the deals are just the 1 year at a time.
Yep.
Also, Andy, there are three types of tax credits. There are legacy tax credits you mentioned that aren't affected by FEOC. And then there are the technology neutral that are fully affected. And then there's this middle category
That's
of
right.
ones for projects that were under construction by the end of last year that aren't affected by the material assistance part of FEOC, but they are by the effective control. And I think we're seeing people transact in all three markets, but obviously it gets a little harder where you're fully affected.
Yeah, that's right. That's right. There's one other category of in between. We've seen a lot of demand for 45Z credits, which are interesting because for 2026, they are not affected by material assistance or by effective control. They are affected by the ownership piece of it, but that one is often easier to diligence for these producers that are generating 45Z credits. They tend to be farmers or yeah, dairy farms or ethanol plants, et cetera.
Mhm.
I was surprised to see how much volume is there. It's just kind of a miss on my part, how much activity there was.
Sure.
Also 45X, which I think has surprised people how much
Yep.
activity in that.
Yeah, Keith, what are you seeing on 45X for 2026? Because that is subject to the FEOC restrictions.
We've probably seen more 45X deals than anything else at this point in the year.
Oh, that's fascinating.
The,
And
the manufacturers are selling on a quarterly basis. So
right, right. And are most of those, I assume those tend to be larger manufacturers that are able to provide a strong guarantee in the event of any FEOC issues.
no, not necessarily. These are battery manufacturers, wind tower,
Mhm.
solar panel manufacturers. They all are doing this, and then they have an option to get direct pay,
Sure.
but for 5 years. But that has been a very frustrating process because it's impossible to find anybody at the IRS to talk to. And we've leaned on congressional offices, we've leaned on senior IRS officials, and even they can't find anyone, given the how much attrition there's been at the IRS.
Have you heard that the payment timing for direct pay has slowed down? Because we do know at the beginning of 2025, for smallish transactions, under 25, 50 million, it was fairly fast in terms of direct pay. But what have you been hearing in the market on timing of getting the refunds?
Mixed stories. The big four accounting firms, some of them have been asking us if we're hearing anybody getting payments. So I think that's the larger payments where basically people would be audited at the front end. It's a mixed story.
Yep, makes sense. Darren, let me ask one to you, which is FEOC does bring this 10-year recapture related to effective control, which is challenging because unlike traditional Section 50 recapture, which is 5 years and steps down 20% per year, this is a full 10-year recapture with no step down. So the full credit can be recaptured at any time if the developer is in violation of effective control provisions. Has there been any industry discussion on how to tackle this risk? I understand it's not coming till 2028, and we're still waiting for guidance, but curious what the discussion has been around this.
Honestly, we have not heard a lot about it, partly because it's a little bit of a future problem, and I think people magically think these issues will get solved. But it's pretty stout, and I think people are going to very quickly look to the insurance markets to help address it. It's going to be tough. I mean, you're going to have to, in the context of the partnerships, you're going to have to insert a lot of covenants around control, and you can run into some other accounting issues in traditional structures. So it'll be pretty thorny for any bank to commit to 10 years subject to somebody else not doing something is always hard to do.
Keith, any predictions on how the insurance market will respond to the 10-year recapture?
That's hard because the insurers will not take risk for sponsor acts. So I'm not sure how you thread this needle at this point. And I think Darren's right. Just there are questions around whether 28 and later ITCs can be sold.
Absolutely. Let's shift gears and talk about 48E and tax equity. Thanks, Darren, for reminding the market or the audience that the market is extremely robust and there is a lot of business going on. People are very, very busy with legacy 45 and 48 credits. That said, there were some headlines around reporting that some of the largest tax equity banks have pulled back from new 48E deals. Given that you've had an inside view, not right now, but in the past, I guess I'm just curious your perspective on how long do you think this slowdown of tax equity investment in 48E will persist?
There's always two things at play, right? There's a business line that has mandates to get capital out to make deals happen. So there will be an incentive to get comfortable with the provisions that are out there. That's sort of an economic driver. And, capital is always looking for places to go. And this industry is not immune to that. In fact, it's been a magnet for capital. So I think that pressure will be very real. But what I think on the other side of it, banks likely, from my experience, will very quietly do it. They won't advertise that they're, writing X amount in term sheets based on what that perceived risk is. They wouldn't want the market to generally think that they're just comfortable with it. But they are going to selectively get comfortable and they will selectively get their capital out.
Andy, I think the important point is the banks. I'm aware of two banks we've heard from directly that have FEOC problems.
Mhm.
And then a third we've heard persistent rumors about. Their issues are whether they
Mhm.
are prohibited foreign entities because they may have too much Chinese debt backing their operations. It's not FEOC issues about the project.
Yeah,
Well,
absolutely.
that's interesting. Yeah. I didn't even
And,
think
and
about it. Yeah.
and Keith, I'm curious if you have a perspective on what the solution is here. We've heard that there's some lobbying efforts to sort of give banks certainty that they will not be considered a foreign influence entity. Is a potential other solution that the FEOC examination is at the partnership level as opposed to the tax equity investor itself?
That's one. Another one is to let banks test debt at time of issuance and not have to track it. Another one, which is related to that, is what is the test date? If you read the statute, it looks like it's just on the last day of the tax year. But then there are two other places where it says if any time during the year X or Y occurs, the Treasury needs to sort that out.
That makes sense. Darren, do you think that due to the headlines about 48E slowdown, and also just FEOC in general, there has been a slowdown in expected development based on where you think it would have been due to some of these factors?
I don't know that the market is seeing that yet. I think what you will see if you think about the pipeline of projects as a continuum, that you'll see probably some breaks in it as a result of this. We've started to hear some folks talk about developing projects with an assumption of no tax credits and just how does that look, and not having to deal with a lot of these issues. I think that there's a sort of a countervailing concern that policymakers wouldn't want that either necessarily, because then you could introduce a whole new flood of imports, which again the policy is trying to prevent. And then that you might hear the words excise tax brought up again. So I think I don't know how realistic that is, but it's out there.
That's a great point. In some ways, it's hard to predict because there could be other policy changes that might happen
Right.
in the future that we don't know about today.
Yep.
A related topic, if some of the traditional banks are slowing down on 48E, we've heard about a proliferation of cash and pref equity providers that are looking to serve as an alternative to tax equity. How much are you seeing this in practice, Keith? Are you seeing a lot of transactions with these alternative providers?
Most of what we're doing at the moment are preferred equity structures. And there are at least a dozen cash investors in that structure. And these tend to be favored by smaller developers, although, Sonova and others, larger people have also taken advantage of it.
And are there other advantages? Are they willing to underwrite, more merchant risk or commercial risk? Is that another driver of the growth there?
No, I think the cash investors are using the same counsel who are acting for tax equity investors, so that those law firms are being careful.
Makes sense.
The one observation I would note on that is that a lot of the capital behind it, it's not bank or regulated the same way. So we've seen that those structures, they've had a little more flexibility in terms of what they can do versus some others, and that's helped, and that certainly has been. But I think to Keith's original point, I mean, we're seeing almost every transaction uses a pref structure of some sort.
That's a great point, Darren. Yeah, a lot of the banks have a very hard cap on step-ups of 15 to absolute max 20%. Are you seeing step-ups push above 20% with the pref structures, Keith?
I'd say two banks, maybe three, have been firm in enforcing that. It's the preferred equity market has been less focused on it.
Makes sense. Great. Well, let's go on to the next topic, which is zooming out a little bit and talking about the legislative outlook post OB3. Would love to talk about some of the near-term potential changes. I'll kick it off with another headline in the news, which is that a group of Republican members of the House introduced a bill to extend the solar and wind ITC. We know this probably is not immediately actionable, but Keith, would love for you to weigh in on that general sentiment of extension of solar and wind ITCs.
Well, you see bills introduced by groups that have coalesced around a proposal, and they're trying to tee it up, but nothing is going to happen in this Congress.
Absolutely.
And it's unlikely to happen in the next Congress, which is 2 years between this November election and the next presidential election. But anything's possible. 18 months is a long time in the political life cycle of this country.
I think, I mean, one of the things we've really focused on are other areas outside of tax policy. So if you think about things like permitting, that is probably, if you really want to talk about a bottleneck to getting projects onto the grid, getting energy into the market, that's probably the single biggest one. And, we've spent a lot of time. It's hard to imagine. Earlier in the year, it seemed possible that there could be something on a bipartisan basis. The question was whether it would get signed. There's a lot of just general distrust in the committees with the other side. But I think we're also spending a lot of time in state level issues, just because I think, to Keith's point, we don't see a lot happening, certainly this Congress and even the next Congress, in terms of real federal legislation around an ITC. It'd be great if they would just focus on clarifying the rules.
Yeah, Darren, I think the permitting question is a huge one because it's top of mind for so many developers. Are there any concrete kind of proposals on the table that you feel optimistic about in the next 12 to 24 months?
There was the SPEED Act, which passed the House, and the Senate, took up a separate version. We haven't seen anything concrete. I mean, there's a lot of things from that were, I think, important and probably could advance, but the deal wasn't quite ready. I guess, the nice thing about it, if there is, all of the trades, including oil, gas, renewable energy, they're all pushing for the same thing. And that would seem to give it more momentum than it's had in the past. I think there's still concern that even if you pass it, projects are still going to have to litigate their permits. And that's really where, if, a sign of good faith might be to revoke the executive orders from a year ago, that might be a good starting point to make a deal, but we'll see. I don't know if that's going to happen either.
I guess on the flip side, there has been concern that there has been targeting of permitting as a way to add additional red tape for solar and wind in particular. Do you see any respite on the horizon for those targeted actions? Will the courts provide some respite there?
Well, not for wind. Solar,
Yeah.
there have been rumors that there's been some relief here and there, particularly Nevada, for example, where the governor wrote an excellent letter, maybe Utah, but not on a wholesale basis. There is a case moving through the courts that Massachusetts District Court judge said the freeze is illegal. There's also a case moving through the courts challenging the Treasury's rewrite of the construction start rules for wind and solar. That hasn't been heard yet.
And Darren, so putting offshore wind aside for a moment, in the solar industry, have the permitting challenges presented any reason for developers to sort of be more judicious or slow down their development because they're afraid of permitting issues that are on the horizon?
Yes, I think it's a very real issue. I mean, many of them are sitting on projects they're ready to go. I mean, I think at one point we counted over 500 projects that were sitting there. If you add up the gigawatts and the billions of dollars that's sitting there ready to deploy clean energy, it's pretty profound. I don't know how that becomes a long-term sustainable and political winning argument to slow a lot of this activity down, but hopefully the dam will break, but we're not seeing it. I think Keith hit it on the head. I mean, we're seeing some sporadic, approvals. We're seeing some litigation that's having some success, but you have to now build in litigation expense just to get your project built. That's tough.
For sure.
There's 70,000 megawatts of
Yep.
projects that started construction by the end of 24, another 70,000 by the end of 25. Those developers are having to ruthlessly go through and weed out projects that are too risky to feel they'll be finished within the 4-year timeframe.
I'm glad you brought that up because that was actually one of our questions. These developers have safe harbored massive volumes of credits. Thank you for the numbers. We know individual developers that have safe harbored 10 or 15 gigawatts each. Do you have a sense of what share of these projects will actually get built? Will we see a flood of projects coming online in 28, 29, and 30, or is that just, will many of those fall out?
I think you're going to see steady financings of these projects, but not all of them will be built because they run into hurdles and the developers just have to fish and or cut bait and move on to things that are more certain to be built in time.
For sure.
I don't have a percentage. It's hard to guess. I once asked a CEO at a dinner what percentage of your projects are ultimately built. He said, over what time frame? I think that's the issue here. There's a limited time frame.
Darren, any thoughts on what the fallout percentage will be?
No, I'd agree with Keith. I mean, we had on the financing side, I felt like, you know, we would, of all the deals we looked at, it used to be a rule of like 1 in 10 were financeable. And, I think the percentage hopefully is higher than 10% on the ones that are in pipeline actually get built. They're going to need to get built.
Yep. Yeah, absolutely. Um, One other question. I mean, it sounds like there's been so much volume that's already been safe harbored. And there was certainly a rush before the end of 2025 to safe harbor projects to avoid the FEOC material assistance requirements. There's one other deadline coming up, which is July 4th, 2026, to safe harbor solar and wind projects to qualify for credits with a 4-year deadline to then place them in service. Have you been seeing a rush of developers looking to safe harbor between Jan 1 and July 4th this year? Or was most of that safe harboring kind of happening at the end of 2025?
We are seeing a rush. It has led to requests of big law firms to bless all sorts of equipment that nobody had ever considered was suitable for physical work. And we're still getting calls, people now rushing out to the sites, asking what they can do in the site in the next 4 weeks. It has not stopped. My colleagues and I are all waiting for July 4. We'll be glad when that date has passed.
You'll definitely need a few days off to celebrate.
Right.
What are the major ways that folks are establishing BOC? There's obviously the transformer path, but I guess what else are you seeing as the second, third, fourth ways that folks are establishing BOC?
Main power transformer, there are some people who are comfortable with single nacelles or more than one nacelle. Beyond that, there's a split in the market. We're seeing people come in with trackers, inverters, inverter skids, little boxes on trackers, um, racking for rooftop solar, you name it. And the big law firms have been slow to warm to this stuff. There are a few that have.
That
Medium
makes
voltage transformers is another one I would put in that box.
Sure. That makes sense. Maybe to put a bow on the post OB3 outlook, any predictions for what the midterms might bring with respect to solar and wind incentives? It sounds like, solar and wind extension is not really, it doesn't feel like that's on the table, but are there other pieces that the midterms might impact on solar and wind?
Darren, do you want to start?
I mean, I'm going to kind of go back to an answer around, not really at that level, but I do think that you could see at different state levels, you could start seeing some shifts if things really swing. Not even so much on the House races, but even at the state level, county commissioners, PUC commissioners. We have an organization that's spending some time at that level, just because that's where we think we can clear up some pinch points. I don't know, that to me is the best outcome, or at least the most we can expect.
I'd be surprised at the federal level. I don't think the big trade associations are pushing at the moment for a tax credit extension. I think there's a possibility the Democrats getting one thing in a trade-off for the Republicans if there's something they want. And the question is, what is that? I remember when the ITC was extended for an extended period of time when the Republicans wanted relaxation of controls on exports of fossil fuels. So you need something like that that would be serve as a nucleus for a trade.
That makes sense. The two other areas that we're watching, one is extension of 45Z credits, which are only valid through end of 2029. And also for BEAT taxpayers, only legacy Section 45 and 48 credits are treated favorably under BEAT. And there's been some debate amongst legal firms as to whether that was a mistake, to only include Section 45 and 48 credits and not other credits such as tech neutral credits, 45Z, 45U, et cetera. Keith, I don't know if you've heard anything in terms of either of those topics, 45Z or BEAT.
Well, on BEAT, having been in the middle of the discussions in 2017 that led to the special treatment for renewables credits, I think what happened here is the trade association's management turned over. The people who were there at the time in 2017 didn't focus on this. I know the law firms like ours were just too busy, focused on other things. It just didn't get put on the agenda. As far as whether relief is possible in that, I suspect not. It's just giving away revenue to renewables that the Republicans don't like. On 45Z, there's a little bit more logic for that, given the push by both parties to increase domestic manufacturing. Having a longer timeline would help in that effort.
And just to say, I mean, we have someone internally talking about a tax bill at the end of the year during the lame duck, a cleanup, so to speak. And that's where I hear these things coming up. But lame ducks are always interesting.
For sure.
If the Congress changes hands,
Right.
then there's less incentive for the Republicans to do anything in the lame duck session, and Democrats as well. The Democrats want to wait until they're in charge.
That makes sense. Let's talk about a couple of big picture issues. One is the electricity industry is becoming increasingly correlated to AI and data center build out. Do you have any worries about that? For example, a lot of projects are being developed with the assumption that there's going to be massive data center demand, but if there is a hiccup in AI, are developers overexposed to AI? Darren, I'd be curious to hear what your thoughts are.
Yeah, it's interesting. I was just at a symposium last week of insurers, and they were talking a lot about AI. And one of the things it happened for us on the bank side, where you just started having so much exposure to an asset class that you had to spread it out and de-risk it, lay it off to insurers or other folks. And some of the big banks are already experiencing this with some of the data centers where there's hardly enough capacity to spread some of the debt financings that they're using. They're not necessarily financing these on balance sheets. They have big balance sheets to do it, but it is a colossal amount of capital that they're going to consume. And that might be one issue. The second one that I think what you're really getting at is if there's an overbuild and you have all this financings out there and, Meta's committed to 10 years, well, year 11 comes around, you still have debt on it and they've gone away because something has replaced chips where we don't need, warehouses full of chips to process and compute. I don't know. It's a good question. But I think the first issue is going to be it'll be capital markets are going to start getting strained in terms of the build out, which is not yet something folks are talking about.
I think they already are. Look at last year. I think the North American project finance debt market was about 280 billion. There's one debt offering out for data centers of 300 billion right now on the market. One large. It's not just one data center; it's a whole collection of them, but by a single company. And so that then strains the mid and smaller sized developers looking for capital because it's all being diverted. I think the jury is out on whether the independent power producers will be affected by any of this. Power prices go up, that helps them. On the other hand, those who are locking in on data centers, some estimates are that as many as 40% of data center projects that are expected to be built this year won't or will be delayed significantly. And then you have all the PUCs under pressure to do something about rising electricity prices. They'll take it out on the utilities who are potential customers for the independents, but they can't reach the independents directly.
That makes sense. The other large macro item is the war in Iran. Darren, I'm curious if you have any perspective on what impact that's having, if any, on alternative energy sources.
It can only be a tailwind. And I think, look no further than China to see where they've absolutely capitalized on this. They have built out renewables at just an exponential pace. And while they still consume, billions of barrels of oil, they seem to have leaned into an alternative energy source, which would seem to be wise at this point for our country to do the same.
It's reminding people what of a lesson we learned during the Arab oil embargo in the 1970s when people started to focus on renewables. I agree with Darren, it is a tailwind for renewables with one caveat, and that is inflation being driven up increases interest rates and makes capital more expensive to build projects.
Yeah, rates will be an issue very soon, Keith. You're right. Yep.
100%. We have a bunch of questions that have come in from the audience, so I think our timing is quite good here. Why don't we shift over and talk about, or just respond to a few things that our audience has asked. One is, I'm hearing that Resi 48E credits have become hard to transact. Is the panel seeing this, and if so, what is the cause? Keith, can I?
Well, I think we discussed that. There are two types of 48E credits. There are ones where projects were under construction by the end of 2025, and they have just part of the FEOC issues, not the whole gamut. And then there are ones that are exposed to the full bet, but we're still seeing people transact in them. It's harder to find tax insurance.
Yeah, and I think sponsor strength comes into play, and you've seen a lot of volatility in the Resi market generally. So you might, capital is going to get spooked first by that, and then second by FEOC.
I agree. We've certainly been getting more and more questions about counterparty strength in light of some of the bankruptcies in the solar side last year. I think that's a general trend amongst buyers, is to be more interested in understanding the strength of the counterparty. I'll also mention that amongst buyers, there's only a subset of buyers that are interested in distributed generation or residential portfolios. Even though we see a lot of benefit in a diversified pool of many projects, there are quite a few buyers. I'd say probably, at least 70 to 90% of our buyers that do express concern on the distributed side. And so it is a smaller segment of our buyers that are interested in portfolios of projects.
That's always been true, Andy, but for one thing, they're more likely to suffer at least some minor amount of recapture, just for the sheer number of systems deployed.
That's completely correct. Yeah, when purchasing a Resi portfolio, it is likely that there will be some true up in terms of recapture that has to be filed at the end of the year. That's less true with community solar projects where there might be a more discrete number of projects. Keith, what is most surprising to you so far about the 2026 tax credit market?
I'm not sure I'm surprised, but it's perhaps ironic that the Trump administration that wants to squash renewables has produced a situation where 86,000 megawatts of new capacity will be installed this year in the US, 93% of it wind, solar, and storage. So if you stop and think about it, if you accelerate distant phase-out dates, then activity accelerates. I'd rather be in that position than be meandering along. Things can always change 2 or 3 years from now.
Yeah, I would echo. I mean, I've met with, all of our board members at SEIA. I've met with, a lot of different industry players, and they are all as busy as they've ever been. There is an absolute truth around the acceleration, and once that acceleration starts, it becomes its own momentum. So in a perverse way, the Trump administration is going to prove to be pretty good for renewables.
And keep in mind, too, the deadline to start construction for everything other than wind and solar is 2033 to get full tax credits, 2035 to get partial tax credits.
That's right, which means the credits will be generated, add 4 years to that till 2039.
Yeah, you'll be ready to retire, Andy.
Keith, which items are most heavily negotiated on your recent transactions? Earlier in the market, tax proceedings was always a big one. We've seen more conversation around sellers wanting to limit their liabilities, and that being a more hotly contested issue. But curious to hear what you've been seeing.
I'd say that the issue that's taking up the most time is Section 49, which is an at-risk limit on investment tax credits. This comes up in any deal where you have individuals or S corporations, closely held C corporations as part owners. It's a complicated area and there isn't agreement among the law firms about how to apply it. Next most is probably dealing with the tax insurers, where they're not going to take risk of sponsor acts, and yet the tax credit buyer has no ability to control them either. So it's a question of who should take that risk, where neither has any particular insider control.
Darren, anything you'd add?
No, I mean, Keith would have a better view of what's getting negotiated the hardest. I mean, you know, we focused a lot on the indemnities. Keith knows that was one of our Achilles heel, so to speak. But it proved to be the right thing to focus on, I think. And I would say that that's still an area where people are going to get hammered.
Yeah, and I think for sure, kind of in line with the flight to conservatism and looking for strong sponsors. I think that gap you mentioned, Keith, on sponsor bad acts is certainly, given that there's a gap in insurance. I think buyers still want to know what the protection is if there's an issue.
There is also still a lot of attention being paid to basis step-ups and how the basis accumulates, particularly where there's debt in the structure, and how long Circle Cash has to stay at a real devco that is selling into a partnership. All those issues are taking on greater prominence because of a tax case that's moving through the claims court, should be decided any day now, called Alta Wen, that may have something to say about how ITCs are calculated. And we're hearing from the tax insurers that they're getting a little skittish about some of the basis issues.
Makes sense. Just let's just do two more questions from the audience here. Someone asked, 48 ITC demand seemed to be slow in Q1 of 2026. Are you seeing increased demand for 48 ITCs today? So has there been an uptick in demand from Q1 to Q2?
I think so. I think what happened, you pointed it out, Andy, is after the OBBA passed, big companies redid their tax calculations. They found they owed less in tax in 2024. That was partly due to the R&D tax credit changes, less to depreciation bonus. The R&D part was a one-time hit, I think. And so 2025, the tax liabilities go back up.
Yep, absolutely. Last question here. Somebody is asking about the best approach to monetize small commercial projects. Is it possible to get insurance on these small projects?
I
It
think if you
is.
have to aggregate them, go ahead, Keith.
No, really, you go ahead, Darren.
In the context of a portfolio, I think it makes sense. Individually, it's pretty inefficient.
I think that this has always been the next big thing, C&I solar, and it's never proven true. You've got to standardize the offtake contracts, otherwise the diligence is just confiscatory.
Yeah, in terms of insurance, there is typically some fixed costs associated with getting insurance. So, we typically see deals that are above $5 to $10 million being sort of the small end of getting insurance, and the number's creeping up because insurance costs have also risen over time as there's been so much demand for tax credit insurance. Is there anything that we missed, Darren or Keith, in terms of closing thoughts? We have just a few minutes left, so yeah, would love to close with sort of any items we should have covered in this 60 minutes. Maybe I'll start with you, Darren.
I mean, I guess I would just continue to voice a lot of optimism around the industry. I know, the three of us here have been around the industry a long time, and we've seen a lot of cliffs. We've seen a lot of headwinds. We've seen, you name it. And I think the proposition is now stronger than ever in terms of the economic pull through. The fact that energy prices are rising and renewable energy, and particularly battery storage, is really just from an economic basis. It's just such a strong asset right now that it'll be hard to keep it down. So I feel really positive about that. I know the industry is facing an enormous amounts of frustration, but we'll, collectively we do get through these things, and we're all in a good industry, I think.
I agree with that. Darren and I are both native Midwesterners, so we're optimists by birth. But I
I am
think,
too, by the way. I'm from Michigan,
okay,
so also
All
Midwestern.
right.
if you look at the International Energy Agency data about capacity additions, the curve with renewables is a steeply rising curve, and it has been really since 2004. Whereas fossil fuel new capacity additions have been slowly declining. And that has nothing to do with U.S. permits, U.S. tax credits. This is a global economic phenomenon.
Well, thank you both, Keith and Darren, for sharing your thoughts today. I really enjoyed the conversation, and I share your optimism around the industry. I've also been on the solar coaster, as we all call it, for quite some time, and I think in some ways, the longer you've been on the solar coaster, the more you have confidence that things will work out, and the unrelenting demand for energy and for clean energy will sort of win out in the end. So definitely share your optimism for lots of exciting projects and additional capacity going in the ground in the years to come.
Well, thank you, Andy.
Yep. Thanks, Keith.
Take care.
Yep. Bye.